Assalamu Alaikum everyone, welcome back to another video. I hope you're doing great. Right, so in today's video we're going to talk about 5 different companies that are currently trading under their intrinsic values based on Morningstar valuation. So these companies are trading below 15 to almost to 24% below their intrinsic values. Some of them are great businesses, some of them are still companies that have had a couple of issues in the last whatever months. Nevertheless, great businesses overall. So what I'm going to do is I'm going to share with you guys the 5 companies. I'm going to give you basically just a kind of overview of each one of the companies, and then of course if you're interested in any of these, please always do your own research and find out a bit more information about these companies. If you haven't joined us at the Patreon account, please do so. It really genuinely helps the channel. You can join the Discord of brothers who are ancestors who are sharing really good practices on daily basis, where there's stocks that they buy and research, they found it, just anything to do with news and so on. So it's really great hangout if you would basically be interested. And of course we do have a lot of exclusive stuff on the Patreon account where you can get access to, InshaAllah. So overall the S&P 500 is doing absolutely great. We got short week in terms of trading side of things because we got the New Year's Day and so all of these things coming up. So yeah, it will be interesting to see how the week starts. Today is Monday morning, so I'm recording just this morning, just Monday morning. So we'll see how the week goes, and I'm going to share with you these 5 companies. We've got a lot of videos planned, inshallah, in the next couple of days, so stay tuned for that. If you haven't seen the 2 videos that I've done in terms of ETF side of things, please go and watch them, because genuinely that you get a lot out of those, especially if you are new to investing and so on. And I've got a few more videos to plan for us, inshallah. And I'm going to do a portfolio update, but I'm not going to do you the usual portfolio update this month. I'm going to slightly do something different that I think will help the community massively, inshallah. Right, let's get started with these 5 companies. And what we're going to do first is just look at the information that we normally search for when we're basically looking at this. And a lot of this information comes from either Seeking Alpha or Morningstar, basically. And these 2 websites are, of course, subscription based. They have free services, but you can't get all of this information. And that's why I always ask you guys, if you can join us the Patreon account, it will genuinely help basically pay for these things, inshallah. So what are we looking for? We're looking for the market cap. We're looking for the moat. The moat is basically what helps companies have a competitive edge, if you like. We're talking about price. So companies with the rating, moat rating, or for example wide moat, have basically a competitive advantage over their competitors, if you like. We're looking for the current price, the dividend, basically information. We're looking at the 5-year growth rates in terms of revenue, in terms of EPS. We're looking at profitability and how the management is using the money, that the capital that's available to them. We're looking at the free cash flow. That's where a lot of the money comes from in terms of dividends, in terms of buybacks, and a lot of these things, paying off debt and so on. We're looking for where what the company has done over the last 10 years. Have they basically done a lot of shareholder value side of things in terms of return to investors and so on, where there's dividends, where there's buybacks and all of these things, right? But mainly this one is capital appreciation and dividends. So those are the 2 things that basically that are included in the total return side of things. Revenue growth for next year, that's just to estimate what the analysts currently think where the company should be next year. EPS is exactly the same, and then we're looking for Morningstar valuation. Now let's get started. And the first company we're going to talk about today is AMD. I've spoken about this company recently. It's still undervalued, about 22% right now. $160 is where they think the price should be. Right now is $125 per share. Narrow mode, in terms of mode, I think there are other companies that slightly have the wide mode in comparison. It is quite a competitive world that basically they live in right now in this company, because they are working with the Intel has not done well over the last whatever years, right? But they're in the same sort of a market. Some of their products include CPUs, GPUs, APUs, for example, which is accelerated processing units and so on. They've also got high performing computing, so HPCs. They've got software side of things where they kind of optimize the drivers and things like that go into those hardware that they have. They've also got data centers, which is basically one of the major things that they have. In terms of AI side of things, the data centers have been the center of everything over the last whatever months that we've talked about. So they are also in that market, and they have been on this data center basically side of things is actually growing massively. So this is a very interesting company. Genuinely, I'm I'm currently looking at it and thinking, could I actually include this in my overall portfolio? But we'll see, inshallah. I'll let you guys know if I do. Now, currently looking at a year to date, for 1 year, for example, is actually down 14%. A year down is about 15%. And currently it has a PE of 37, which is, in my opinion, slightly higher, because when you look at valuation, for example, for this company, this is the bit that you really need to take into consideration, because in the long run, because you cannot invest in companies just based on what Wall Street is saying. You just need to know where basically the company has been over the last whatever months, years. And this is what I mean. You need to look at the 5-year average for this company, for example, when it comes to PE, either non-GAAP or GAAP, whichever you're basically interested. So non-GAAP, for example, we're looking at about 53. This is where it has been. Right now is 41. So it's slightly cheaper than where it has been. But the sector medium is about 24. So it's slightly way more expensive than, of course, that. So you have to take that into consideration. And the other final thing I wanted to show you is when it comes to earnings expectations moving forward is here, of course. I've added it there, but 27 and 53% expected to grow for the next year. Now, that's just the next year. So when it comes to EPS, revenue side of it, we're looking at 26%, 23%, 18%, right? And when that's year over year growth, 25% basically was 2024, 25 we're looking at about 53, 38%, 29%, and 27%. Even if you just focus on the first three, that's still massive growth for this company. So we will see. Wall Street is actually saying, let's see what their price targets are. So they've got 30 strong buys, 7 buys, 12 holds, and when we look at 46% undervalued at the moment, according to them, $182 per share is where they think the price should be. Right now we're looking at $125 per share. So it'll be interesting to see where the company ends up, but it seems very much undervalued. There's slight risk to that company all the time, and every time I look at it, and I'm like, I've seen it move. Sometimes it can move a day within 5, 6, 7%. Basically what Broadcom and Nvidia has done, but when it goes down a lot. And I don't know if I've got the stomach for that for right now, considering I'm trying to build a portfolio of stocks that has a lower beta, if you like. But it would be interesting to see in the long run where we end up with this company. The next one is AstraZeneca. Is a company that has been in my portfolio quite some time. There have been some issues in the US, in China, for example, recently. I still feel the company is in a great place. It's undervalued at the moment. And if we go on here and just kind of have a look at similar thing that we've done for in terms of valuations, if we look at the 5-year average, we're looking at about 20, and right now it's about 17. So it seems slightly cheaper than where it used to be. Earnings expectations, we're looking at about double digits, high double digits, 15%, 16%, almost 18% there. We look at revenue side of it, we're looking at about 7%, 8%, 6% more or less. So it is doing well in overall. It's been the only reason why it has come down quite a lot. It was because of what's happening in China. I think that day it dropped about, I can't remember, 12% or whatever it was. And as you can see, the basically 52-week high was $87 per share. Right now we're looking at about $66 per share. And the China situation is something that's been ongoing, and I don't know if it's going to be solved anytime soon, but we will see what comes out of that investigation. If they might be guilty, they might not be guilty. But right now they seem 15% undervalued at the moment. $78 per share is where they think the price should be. You get 2% dividend yield, which is quite nice. So interesting company, but we will see where we are. But when it comes to free cash flow, basically total return the last 10 years, and the growth expectations, it's all there. It's absolutely there. So nothing to worry about in my opinion. The next one is another one that we've talked about a lot, and that is ASML. This, I believe, genuinely will be, and I've said this about for the last 3-4 years, is probably one of the most important companies out there in terms of in the world generally, basically similar to TSMC. So Taiwan Semiconductor and this company, both of them combined, is probably the most important companies out there right now. And the reason I said that is because this company makes basically the equipment that's needed to make those chips that go into every single device out there. We're talking about the stuff that goes to in your fridge, your car, the airplanes, you name it. Every single device that's been made that has some sort of a microchip in it has to be made by the manufacturing, basically TSMC, and using the product this company creates. So, and they cost, I don't know, 300 to 500 million a piece. So this is probably one of the most important companies in my opinion. So $280 billion market cap right now. It has a wide economic moat, $713 per share right now. It has actually basically come back up a little bit from where it was. I think it was at one point when it dropped and I bought more, it was about 600 something. So dividend yield 0.9, so let's call it about 1%. So the growth is there. You get $6.71 for every share of that company that you own. In terms of the 5-year growth rate for moving forward, we're looking about not the 5-year, the revenue growth for next year, we're looking at about 15%. EPS, we're looking at about 22%. It's 24% discounted right now. $935 per share is where they think the price should be. And when it comes to all of these metrics, for example, profit margins, return on equity, return on invested capital, probably one of the best companies out there. And if we look at basically where the company has been for the last 6 months, we're looking at about 31% discount, basically down from where it was. So at one point it was $1,110 per share right now, and it hit about $645 per share. I think that's when I started buying. If we look at the valuation again, 44 used to be the average PE for this company. Right now it's slightly lower than that. And when we look at the earnings expectations moving forward, if you look at the next year, we're looking at about 22%, 26%, 25%. You know, all of this, it's double digits here for earnings per share side of things, and revenue 15%, 15%, 13%, 8%. So nothing to worry about. And when it comes to Wall Street, majority of them are very bullish on the company, because what they're saying is about 26% up, basically upside from where we are. $900 per share is where they think it should be. 21 strong buys, 8 buys, and 10 holds, which is absolutely fine. So another company that is really in a very good position is actually down a lot. So we will see what happens. The next one is Danaher Corporation. This one is flat for the year. Okay, basically in the last 6 months is down about 8%. When we look at the 252-week high was 281, right now $231 per share. If we look at valuation side of it, 30 used to be where it used to be. Right now it's about 31, so it's not much in terms of the where you used to trade. And if we look at, for example, the earnings expectations moving forward, we're looking at about 11% in next year, 12%, almost to 12% for the next couple of years. And when it comes to revenue side of it, 6%, 7%. So this is one of the companies that is a pharmaceutical company. They make a lot of these a lot of the life sciences tools that basically that are used in different types of industries. So right now, in terms of the expectations from Wall Street, for example, we've got 18 strong buys, 5 buys, 5 holds, and they're expecting the earnings to grow. I was just checking if we're looking at the right company, because I thought it was slightly lower. We're looking at about 25% almost upside from where we are right now. $287 per share is where they think the price should be. If we look at the earnings expectations moving forward, okay, you see 11%, 12%. So we've already seen here, but that's really interesting. Okay, so 11, 12%, and then the raises. I'm a little bit surprised to actually to see how bullish Wall Street is on this type of companies, because normally they're not. And as you can see here, it has wide economic moat, $231 per share, dividend yield 0.47, let's call it 0.5. They have been increasing for the last 11 years, and they have a dividend safety of 73% from Simply Safe Dividend, and they've done well over the last 5 years when it comes to revenue side of it, when it comes to EPS side of thing. Return on invested capital is not great, but is I think hopefully will increase. Free cash flow $5 billion. Total return in the last 10 years, we're looking at about 13%. Revenue expected to grow about, like we've seen already, 6%, and then 12% after that, 19% discounted. Right, the next company is Dexcom. This is one of the diabetes. They have a product for diabetes and things like that. They are in the healthcare side of things. So they provide the monitoring systems that basically people with diabetes use and so on. Currently has a 31 billion market cap, narrow economic mode, $80 per share. They don't have any dividends yet. They've done well over the last 5 years when it comes to revenue and EPS. They're doing really well when it comes to profitability in terms of return on equity, return on invested capital, and things like that. $500 million of free cash flow right now, 20%, almost 19% basically total return in the last 10 years. And they're expecting the earnings to grow about 15%, 19% when it comes to EPS, and also revenue side of 15 and 19% when it comes to EPS. 15% discounted, $94 per share right now. And if we look at where the company has been on the last basically year to date, you can see we've got 35% basically under just gone down 35%. The lowest basically it hit was $62 per share, and the highest was 142. Right now it's $80 per share. If we look at the in terms of valuation side of things, 122 used to be the PE. Right now we're looking at about 47. So maybe that's not a good indication, because it's probably been high growth company before. As you can see here, we got 2024, we got about 19%, 20%, 20% here. We got 14, 15% when it comes to revenue side of things, which is just absolutely amazing. And if we look at the Wall Street expectations for this company, 15 strong buys, 5 holds, and overall about 20% upside from where we are. So overall, these are all great companies that are currently trading and basically undervalued at the moment. And a lot of people are overlooking this. And a lot of the time, I've always said to you guys, you better basically off buying discounted companies that are really good, in a very good position, like companies like ASML, for example, that I know and I own. By the way, these two I own in my portfolio. The rest of them I do not own. And one of the things I've learned over the last whatever years is you're better off buying these companies when they're undervalued than actually buying them when they're either overvalued or fairly valued. Because what's going to happen is, if the stock market goes down, they basically, if you get one of those situations when the stock market, basically companies go back to their intrinsic values, then you're in trouble. They're genuinely in trouble. So be mindful of those things. Always look for discounted companies, but at the same time, sometimes it's not bad to pay a little bit more money for high quality companies. But at the same time, we're talking about the stock market, and if you can't stock market, then of course you need to be careful. Okay, so Sharia compliance side of things, nothing to worry about. All of them are fine. This one is got about 26%, so I would be a bit careful, because it can easily change. That 1% can easily change. So just apart from that, the rest of them are fine. Like I said to you guys, I've got a lot of videos planned for us, inshallah, in the next couple of days. Join us at the Patreon account. That would genuinely help the channel, inshallah. Have a wonderful day. Assalamu Alaikum.